Some things get an accelerated depreciation, and you have what's called intangible drilling costs. So you have all these different things that are deductible. Okay? All right. And then we have REITs. Now, REITs invest in real estate. They either invest in owning commercial property or they invest in owning the mortgages on commercial property. Or you have hybrid REITs, which are a little bit of both. But it's a way to invest in real estate kind of in a safe, secure way. So they're kind of like mutual funds for real estate, but they're not investment companies. In other words, they're not registered as investment companies under Investment Company Act of 1940. Now, they can be public or private. Public would mean that, of course, they are registered with the SEC. Private, which is obviously more risky, right? They're private placements, which would only be available to accredited investors. They can also be listed or non-listed. Now, listed would mean that they're on the New York Stock Exchange, which means they're very liquid. They can be easily sold. And, of course, the exchanges are considered regulators as well. So if a company is listed on a stock exchange, then they've been vetted not just by the SEC, but by the exchange itself. So obviously, a listed security is going to be less risky than a non-listed security. Okay? So 4 important points to remember about REITs. It's an undivided interest in a pool of real estate investments. They can be registered or not registered, public or private. They can be listed or not listed on an exchange. And they are not investment companies listed under the Investment Company Act of 1940, right? So they offer dividends and gains to investors, but do not pass through losses like the direct participation programs, okay? Then we have hedge funds. Now, hedge funds are private, also known as private funds, because only accredited investors can invest in them. Hedge funds are infamous for using very risky and highly speculative types of advanced trading methods. And so only accredited investors can invest in them. Now, they're generally not considered suitable for regular investors because of the high risk and how complicated they are. Generally, to get into one, you have to have a very large initial investment. You know, 500,000, $1 million, 10 million, depending, right? And generally, they have a lockup period or a minimum holding period where the investor cannot take their money back out during a period of time. So when you first put your money in, your money's kind of locked into the fund for a while because they don't want people yanking their money out when things start getting scary. Okay? All right. And then we have exchange-traded funds. So exchange-traded funds are very much the same thing as a closed-in investment company. They're sold in the secondary market, so which means they can be purchased on margin, sold short, and they're typically designed to mimic an index like the S&P 500, the Dow Jones, things like that. Sorry. And so there's very little management of these. The only active management would be changing the companies inside of the fund because the index itself changed. All right. Yeah. And then we have exchange traded notes. Now, I don't think you're going to get a lot. Oh, I don't even have, I took my slide out. I took the slide on exchange traded notes. So I don't think that's something that's showing up. Okay. All right. Now we're going to finish up this chapter with investment risk. Now, this is an important section because you do need to understand these risks. I do know that they ask questions on these, so make sure you have these down. Okay? Mm-hmm. All right. So these are the different type of risks. Now, first off, you have systemic or systematic and non-systemic or non-systematic risks. Okay? Now, if it's systematic, that means it belongs to a system. It's changes in the overall economy because of things like war, global threats, or somebody starts issuing a whole bunch of tariffs, you know, crazy things. And so when that happens, it affects the entire marketplace. Okay? And so there are 5 systematic or systemic risks. First off, you have market risk. Now, this is the risk that the entire market goes into the tank. And if that happens, then what? Then it doesn't matter what's going on with your company, it's going to go down. In other words, a company that's in a completely unrelated business to something else that was affected, right, is going to be affected by the entire market going down, right? So if a major index were to drop substantially, your entire portfolio of stocks would be affected, okay? Next, we have interest rate risk. Now, it's interesting that with bonds, you have a risk in both directions, which we talked a little bit about when we talked about bonds. So if interest rates go up, that's interest rate risk. If interest rates go down, that's call or reinvestment risk. So interest rates going up, what's bad with that is if interest rates go up, then the price of bonds in the secondary market go down, meaning that you cannot go out in the marketplace and sell your bonds and get your principal back.
Yeah.
Okay? So interest rate risk is that interest rates rise and the bond prices fall. Then we have reinvestment risk. Now, reinvestment risk, which would include call risk, right, is the risk that interest rates go down. And because of that, either your bond matures or it's called, you're going to get all of your principal back, but you cannot go out in the marketplace and reinvest that money with the same level of risk and get the same income. And so I use the example, so, to help stick in your mind, of the person that's got a 5% bond and is living on, got $1 million of bonds. And so they're living on $50,000 a year. Interest rates go down.